Capital collapse here. If you've been watching the silver market, what I'm about to show you has never occurred in the history of commodity futures markets, and it signals something massive is about to break. In a normal month, 1% to 3% of COMEX silver futures contracts settle for physical delivery. The remaining 97% to 99% either roll forward to the next contract month or cash settle. That's how the paper market functions. It's a game of musical chairs where almost nobody actually demands the metal. February 2026, 100% physical settlement, 3,500 contracts in the first 4 days of the month, every single one demanding physical delivery. That's 17.5 million ounces of silver, all accepted for delivery. No rollovers, no cash settlements, just raw demand for the actual metal. At the exact same time this 100% settlement rate is happening, 3 million ounces were drained from COMEX vaults in a single 24-hour period on February 3rd. Nearly 2 million ounces withdrawn from Asahi refining vaults, over 900,000 ounces pulled from HSBC, another 282,000 ounces removed from JP Morgan's vaults, and 2.5 million ounces adjusted into Loomis registered category, the only silver eligible for COMEX delivery. Total COMEX silver inventory has dropped to 400 million ounces. That's a single day drain we haven't seen in years. Physical metal is bleeding out of the system. This isn't speculation. This isn't a prediction. This is raw, verified data from COMEX's own daily vault reports. While 3 million ounces are being physically removed from COMEX vaults, 600 more silver futures contracts were issued delivery notices in just the first 4 days of February alone. All accepted for physical delivery. That's another 3 million ounces on top of the 17.5 million already demanded. The inventory is draining. The delivery demands are accelerating. Normally when this happens, you'd see futures players panic and roll their contracts forward to avoid taking delivery. That's the safety valve. That's how the system relieves pressure. But that safety valve isn't working. The players demanding delivery right now aren't speculators. They're not hedge funds playing volatility. These are industrial users, aerospace contractors, defense manufacturers, solar panel producers, sovereign entities who need physical silver for real-world applications. You can't build missile guidance systems with paper contracts. You can't manufacture semiconductors with COMEX receipts. You can't produce solar panels with cash-settled futures. These entities need the actual metal, and they're willing to stand for delivery at any price, because without it, their production lines stop. This is industrial and strategic demand colliding with a paper market that was never designed to handle 100% physical settlement. The cracks are starting to show. Silver crashed 22% in 2 hours on the Shanghai Futures Exchange, from $90 down to $73 overnight, the most violent takedown in precious metals history. 1.44 million contracts traded on the April 2026 silver futures alone in a single morning session. That's equivalent to 674 million ounces of paper silver. Across all contracts that morning, 1.34 billion ounces traded. That's almost double the entire annual global silver mine production, traded in one morning. This wasn't retail panic. This was a systematic, coordinated short-selling attack designed to flush out leveraged longs and create maximum pain. But despite that 22% paper crash, the Shanghai spot price maintained a $10 to $15 premium over Western spot and futures markets. Even after the violent sell-off, physical silver in China is still trading at a significant premium. Western spot, $75. Western futures, 76 cents. Shanghai spot, 86. Shanghai futures, $90. That premium is not speculation. That's physical demand holding firm even as paper markets are manipulated lower. When physical silver trades at a premium to paper silver, that's the market telling you one thing: there's not enough real metal to meet real demand at the paper price. That premium has been persistent. It's been holding at $10 to $15 for weeks now, even through the most violent price swings. The physical market and the paper market are diverging, and when that divergence becomes extreme, something breaks. Aerospace and defense contractors need silver for missile guidance systems, radar components, and advanced electronics. Without silver, F-35 production stops. Raytheon contracts go unfulfilled. Lockheed Martin can't deliver on Pentagon orders. Solar panel manufacturers need silver for photovoltaic cells. China is building solar capacity at a scale the world has never seen. Every panel requires silver paste for electrical conductivity. No silver, no solar revolution. Semiconductor fabs need silver for chip production. AI data centers need silver for server components. EV manufacturers need silver for battery management systems and electrical contacts. These are not optional purchases. These are mission-critical materials. When industrial users start bypassing the spot market and going directly to COMEX for physical delivery, that tells you the spot market isn't supplying enough metal at current prices. If COMEX runs out of deliverable silver, the entire price discovery mechanism for the global silver market breaks. because COMEX futures set the benchmark price that every refiner, miner, and industrial user references. If that benchmark becomes disconnected from physical reality, chaos follows. Total COMEX silver inventory, 400 million ounces. But not all of that is available for delivery. COMEX categorizes silver into two types, eligible and registered. Only registered silver can be delivered against futures contracts. As of this week, registered silver at COMEX, approximately 75 million ounces. In just 4 days, 3,500 contracts demanded physical delivery. That's 17.5 million ounces. At that rate, if demand continues for the entire month of February, that's 4.375 million ounces per day. Over a 28-day month, that's 122.5 million ounces demanded, but registered inventory is only 75 million ounces. If this pace continues, COMEX doesn't have enough registered silver to meet demand for even 1 month. They would need to convert eligible silver to registered status, but eligible silver belongs to private owners who deposited it for storage. COMEX can't just take it. The owners would have to voluntarily convert it. And why would they do that if they believe a squeeze is coming? This is the mathematical trap COMEX is walking into. Demand is outpacing supply. Unless something changes, either demand drops off or massive amounts of eligible silver get converted to registered, the exchange is on a collision course with a delivery default. The U.S. Mint sold 16.7 million silver eagles in January 2026, the highest monthly sales in history. Then on February 1st, they announced production delays and suspended sales to authorized dealers. The Royal Canadian Mint suspended silver coin production the same week. Perth Mint in Australia cited refining bottlenecks. The Austrian Mint reported similar issues. This isn't coincidence. This is coordinated. Physical silver is about to become impossible to source at any premium. Bullion dealers are reporting they can't source physical silver anywhere near spot prices. Premiums have spiked 40% to 60% over spot on retail coins and bars. Some dealers have completely stopped taking orders because they don't know when they'll get inventory. You can't fake closed mints. You can't fake empty refineries. You can't fake dealer inventories going to zero. These are physical realities, not paper games. March 2022, the London Metal Exchange. Chinese billionaire Zhang Guangde held a massive short position in nickel through his company Tsingshan Group. Russia invaded Ukraine. Nickel prices exploded due to Russian supply fears. Zhang's short position went catastrophically underwater. Nickel prices doubled in hours. Trading hit circuit breakers. The LME canceled $4 billion worth of nickel trades. They literally erased trades that had already executed. Why? To prevent one participant, Zhang Guangde, from defaulting and taking down the exchange. The LME chose to protect the short seller instead of honoring the contracts. Traders who had winning positions were told their trades never happened. That's not a free market. That's a rigged casino. If COMEX faces a similar delivery crisis, what will they do? Will they honor 100% of physical delivery demands, or will they invoke force majeure, suspend trading, or offer cash settlements instead? COMEX's rulebook includes provisions for exactly this scenario. Rule 4.18 allows the exchange to settle contracts in cash if physical delivery becomes impractical. Who decides what's impractical? The exchange. The same institution that has a vested interest in preventing its own default. If you're holding paper silver through ETFs like SLV, or if you're long COMEX futures expecting physical delivery, there is no guarantee you'll get the metal. The system has escape hatches. History shows they will use them. JP Morgan was fined $920 million in September 2020 for manipulating precious metals markets. The Department of Justice found them guilty of spoofing, placing fake orders to manipulate prices, and systematic fraud across gold, silver, platinum, and palladium markets spanning nearly a decade. They paid the fine. They admitted no wrongdoing, and they kept doing it because the profits from manipulation far exceed the penalties. A $920 million fine is just the cost of doing business when you're making billions from controlling the price of silver. Right now, JP Morgan holds one of the largest derivative positions in silver. Their exposure across COMEX and LBMA runs into tens of billions of dollars. If silver breaks above certain levels and stays there, their short positions become unmanageable. Margin requirements explode. Counterparty risk becomes existential. That 282,000 ounces withdrawn from JP Morgan vaults on February 3rd, that wasn't random. That was strategic positioning. When the banks that manipulate the market start pulling physical out of the system, they're telling you something. They know what's coming. Western spot silver at $75, Western futures at $76. We tested the $87 to $90 resistance zone multiple times over the past week. Each time we got rejected. That level is acting as significant resistance. The 150-hour exponential moving average is currently at $96. That's $21 above current price. If we can break above $87, hold that level, and push toward $96, that would be bullish confirmation that the physical demand story is overpowering the paper manipulation. Right now, we're below that key resistance. When resistance holds multiple times, it signals the market isn't ready to break out yet. Bulls are trying, bears are pushing back. We're stuck in this $73 to $87 range. Support levels to watch. $73 was the overnight low during the Shanghai crash. If we break below that on a daily close, the next support zone is $70 to $71. Below that, we could retest the $65 to $67 zone. COMEX silver open interest dropped to 142,368 contracts as of February 3rd. That's the lowest level since May 2025. Open interest at multi-month lows typically signals capitulation. Weak hands are out, leverage longs have been liquidated, the speculative froth is gone. When open interest drops this hard, it usually marks bottoms. Not always immediately, but the forced selling is complete. The question is whether physical demand can now take over and drive price higher, or whether we need more time to consolidate. Deleveraging is real. Speculative positions are being liquidated globally. Margin calls are forcing weak hands out. This is not a silver-specific issue. Risk-off sentiment is spreading across all asset classes. Bitcoin dropped below $74,000 for the first time since April 2025. The S&P 500 closed down 0.8%. NASDAQ declined 1.5%. Wall Street Fear and Greed Index is at 39, fear territory. When investors are scared, they sell everything and raise cash. Bond yields are spiking globally. The German 30-year bond yield just hit its highest level since 2011. The U.S. 10-year Treasury yield is approaching its highest level since August 2025. Japanese 10-year yields are near the highest since 1999. This is systemic stress. When bond yields spike like this, everything sells initially, including metals. Geopolitical risk is escalating. Reports of potential conflict with Iran are breaking headlines. Historically, the initial reaction to war is risk-off. Sell everything, raise cash, wait for clarity. Only after the dust settles does the safe haven bid for gold and silver kick in. If geopolitics worsen, we could see more downside volatility before the sustained rally begins. Technically, the 150-hour EMA at $96 is now resistance, not support. We tested $87 to $90 and got rejected. That rejection matters. Bulls tried to push through, couldn't hold, got pushed back. If we can't reclaim $87 and break above $96, the path of least resistance is lower. COMEX could invoke force majeure. They could change the rules mid-game, just like the LME did with nickel. If delivery demands become unsustainable, the exchange can legally force cash settlements or suspend physical delivery. That would kill the squeeze thesis instantly. The bearish case is real. Deleveraging, rising bond yields, geopolitical uncertainty, technical resistance, and the possibility of exchange intervention. These are all legitimate risks. 100% physical settlement at COMEX is unprecedented. This has never happened in the modern commodity futures market. Industrial users are bypassing the spot market and demanding delivery directly from the exchange. The spot market is broken. There's not enough physical silver available at current prices to meet real demand. The Shanghai premium is holding firm at $10 to $15 despite the overnight crash. Physical silver in China is trading 18% above Western paper prices. When physical consistently trades at a premium to paper, that's the market screaming shortage. Global mints are shutting down or backlogged. The U.S. Mint suspended Silver Eagle sales. The Royal Canadian Mint, Perth Mint, and Austrian Mint are all facing similar issues. Bullion dealers can't source physical silver anywhere near spot prices. Premiums have spiked 40% to 60% over spot. You can't fake closed mints. You can't fake empty refineries. You can't fake dealer inventories going to zero. These are physical realities. COMEX registered inventory is at dangerously low levels relative to delivery demand. If this pace continues, they run out of deliverable silver in weeks, not months. Unless massive amounts of eligible silver convert to registered, they face a mathematical impossibility. More demand than supply. Open interest is at multi-month lows. The weak hands are gone. Speculative longs have been flushed out. Leveraged positions have been liquidated. What's left are strong hands. Industrial users, long-term stackers, entities that actually need the metal. Silver's fundamentals are overwhelmingly bullish long-term. Industrial demand is growing due to solar, EVs, 5G infrastructure, and AI data centers. Mine supply is flat to declining. Above-ground inventories are being drained. Central banks are shifting reserves into hard assets. The bearish case focuses on short-term volatility and manipulation. The bullish case focuses on structural supply-demand imbalances that cannot be papered over indefinitely. While we're focused on silver, gold is telling the same story. Central banks purchased 328 tons of gold in Q4 2025, just below the 345 tons bought in Q4 2024. Gold acquisitions by central banks have continued for 33 consecutive months. 33 straight months of buying. Poland led with 102 tons. Kazakhstan bought 57 tons. China won't even report how much they bought, but Shanghai import data shows over 400 tons in unreported purchases. The 12-month moving average stands at a massive 27 tons per month. The central bank gold buying supercycle shows no signs of slowing regardless of price fluctuations. These are the smart money institutions. They're not buying because they think gold is going to $5,000 next week. They're buying because they see the long-term trajectory of fiat currency debasement, and they want hard assets. Gold just posted its largest one-day gain since 2008. $311 in a single session. That's a $2 trillion shift in global gold valuation in 24 hours. Silver moved in tandem, up 14% that same day. When gold and silver move together like this, it's not speculation. It's the system repricing what money actually is. Silver moves with gold, but with industrial demand layered on top. When the gold bull market accelerates, silver follows. And with industrial demand consuming 60% of annual silver production, any supply disruption creates immediate price pressure. The state of Wyoming just started buying physical gold and selected a private vault over JP Morgan for storage. That's not speculation. That's official state policy. A U.S. state is bypassing the traditional banking system to hold physical gold because they don't trust the paper markets. Institutions are waking up to the reality that traditional portfolio construction, 60% equities and 40% bonds, doesn't work in this era. U.S. 10-year bonds are down 50% since 2020. Gold is up 3 times. Current U.S. gold holdings in institutional portfolios, 1.4%. Imagine what happens to the price of gold and silver if even a small portion of that 40% bond allocation shifts into precious metals. We're talking about trillions of dollars potentially moving out of bonds and into hard assets. The repricing would be biblical. UBS came out and said they believe both gold and silver can move even higher in 2026. Pullbacks this violent in a secular bull market usually mark the start of the next leg up, not the end. Institutional conviction hasn't wavered. If delivery demand continues at 100% and registered inventory keeps draining, COMEX faces a default. They invoke force majeure, suspend physical delivery, and force cash settlements. Silver prices spike initially due to panic, then crash as the squeeze thesis dies. Trust in paper silver markets collapses. Physical silver decouples from paper and trades at massive premiums in the spot market. Probability, 25%. COMEX has every incentive to avoid this. They'll change rules, raise margins, and do whatever it takes to prevent outright default. Holders of eligible silver voluntarily convert their holdings to registered status, replenishing deliverable supply. This buys COMEX time. Delivery demands continue, but the exchange can meet them for now. Silver consolidates in the $70 to $90 range for months. The squeeze is delayed, but the underlying fundamentals, industrial demand outpacing supply, remain intact. Probability, 50%. This is the most likely near-term outcome. The system limps along, barely meeting demand until the next crisis. Eligible silver owners refuse to convert because they see the squeeze coming. Delivery demand accelerates as more industrial users panic. COMEX can't meet demand. Silver breaks above 96 ARCs, then 110, then 145 hours. Short sellers get liquidated. Hedge funds rush to cover. Retail FOMO kicks in. The Shanghai premium explodes to $30 or more. Governments step in with export restrictions or price controls, further reducing supply. Probability, 25%. This is the high volatility chaos scenario. It's possible, but requires multiple catalysts to align. COMEX Daily Vault reports, are registered inventories continuing to drain, or are we seeing conversions from eligible to registered? If drains continue, we're heading toward a crisis. If conversions start happening, the system gets more time. Delivery notice trends. Is 100% physical settlement continuing, or does it drop back to normal 1% to 3% levels? If it stays at 100%, the pressure is building. If it normalizes, the squeeze thesis weakens. Shanghai premium behavior. Is the premium widening or narrowing? If it widens to $20 or $30, that confirms physical scarcity is overwhelming paper manipulation. If it narrows to $5 or less, it suggests supply is catching up with demand. Technical levels, can we break and hold above $87, then $96? If yes, bullish confirmation. If we break below $73, we're retesting $70 or lower, and the squeeze thesis is on hold. Open interest changes. Does open interest stay low, or does it start rebuilding? Low open interest suggests accumulation by strong hands. Rising open interest could signal new speculative positions entering, which adds volatility. During Germany's hyperinflation from 1914 to 1923, the gold price went up 1 billion times. 1 billion. Monthly volatility ranged from negative 30% to plus 160%. Even with perfect foresight, even if you knew gold was going to the moon, you would have experienced gut-wrenching volatility. This is normal in precious metals bull markets during currency crisis. The volatility isn't the problem, it's part of the process. Silver crashing 22% overnight, then rallying 18% the next week, that's not abnormal when fiat currencies are being debased at unprecedented rates. The question isn't whether you'll experience volatility. The question is whether you can hold through the volatility to capture the long-term repricing. Most people can't. They buy at tops, panic sell at bottoms, and get shaken out before the real gains materialize. Fundamentally, the gold and silver bull era is 100% intact. The story being told by mainstream media that because a new Fed chair will supposedly keep decision-making independent from the US government, gold needed to fall $1,200 per ounce and silver needed to fall $50 is 100% nonsense. 3 billion gold-obsessed citizens of China and India, and a growing number of Western investors, don't need central banks to validate their gold and silver purchases. Their focus is on building savings in hard assets rather than adding more fiat and debt. The bull market thesis doesn't hinge on who runs the Fed. It hinges on whether the underlying fundamentals, debt levels, currency debasement, and physical supply-demand dynamics remain intact. Nothing in those fundamentals has changed. If you're trading silver with leverage, you can get wiped out. Volatility in this market is extreme. We've seen 22% crashes in hours. Margin calls are brutal and unforgiving. Even if you're right long-term, short-term volatility can liquidate your position before the thesis plays out. If you're holding paper silver through ETFs like SLV, understand that you don't own physical metal. You own shares in a fund that claims to hold silver. Those funds have legal disclaimers allowing them to settle in cash if physical delivery becomes impractical. Read the prospectus. The fine print matters. If you're buying physical silver, understand that premiums can collapse as fast as they spike. Right now, premiums are 40% to 60% over spot on retail products. If spot crashes to $50 and premiums collapse to 10%, your $85 silver could be worth $55 in a liquidation. Physical protects you from systemic risk, but it doesn't protect you from price volatility. This is war-driven, geopolitically charged price action. Headlines can change in hours. What looks like a breakout today could be a bull trap tomorrow. Nothing is guaranteed, not the bottom, not the squeeze, not the delivery crisis. The only thing guaranteed is uncertainty and volatility. If you're a long-term stacker with a time horizon of 5 to 10 years, all of this short-term noise is irrelevant. Daily swings, hourly charts, COMEX inventory levels, EMA tests, none of it matters if your thesis is monetary debasement, industrial demand growth, and systemic distrust of fiat currency over the next decade. For stackers, the only questions are, can I source physical metal, and is the premium reasonable? Everything else is just volatility you ignore. You're not trying to time the bottom. You're accumulating a hard asset that can't be printed, can't be diluted, and has 5,000 years of history as a store of value. But if you're a trader, if you're using leverage, if you're playing short-term moves, then every level matters. You need to know your risk tolerance. You need to know what you can afford to lose. You need to understand that this volatility can wipe out accounts before you have time to react. Know which game you're playing. Stackers and traders operate in completely different time frames with completely different risk profiles. The artificially low prices created by these paper market raids are building the conditions for a major bull market in silver. Every time they smash the price down with coordinated short selling, they create even more real physical demand as industrial users and stackers accumulate at suppressed levels. Meanwhile, supply dwindles. Miners can't invest in new projects at $75 silver when their all-in sustaining costs are $22 to $28 per ounce. Yes, they're still profitable, but the margin doesn't justify major capex for expansion. So mine supply stays flat while demand grows. Refiners face bottlenecks. Mints can't keep up with retail demand. Industrial users are securing long-term contracts at prices well above spot because they can't risk production disruptions. Every manipulation event tightens the physical market further. Every raid creates more demand. Every sell-off flushes out weak hands and concentrates silver in strong hands who won't sell. The paper shorts are building their own trap. David Hunter, a credible macro analyst with a strong track record, just raised his gold price target from $5,500 to $6,800. He raised his silver price target from $125 to $180. That's a credible analyst raising targets while everyone else panics. He's not doing this because he's chasing momentum. He's doing this because the fundamental case for precious metals has strengthened, not weakened. The volatility we're seeing is noise. The structural drivers, debt explosion, currency debasement, industrial demand growth remain intact. When professional analysts start raising targets during violent sell-offs, that tells you they're looking through the short-term volatility and focusing on the long-term trajectory. They're not reacting to price, they're reacting to fundamentals. Something unprecedented is happening in the silver market right now. 100% of COMEX contracts are settling physically. That has never occurred in the modern futures market. Industrial users are bypassing the spot market and demanding delivery directly from the exchange. At the same time, 3 million ounces drained from COMEX vaults in 24 hours. Shanghai is maintaining a persistent $10 to $15 premium despite violent paper sell-offs. Global mints are shutting down or backlogged. Registered COMEX inventory is dangerously low relative to delivery demand. These are not normal market dynamics. This is a system under stress. Physical demand is colliding with paper manipulation. One side has to give. The bearish case says deleveraging, geopolitical uncertainty, and exchange intervention will keep prices contained. The bullish case says physical scarcity will eventually overpower paper games and force a violent repricing. The math doesn't lie. If delivery demand stays at 100% and registered inventory keeps draining, COMEX faces a crisis within weeks. Either they meet demand and run out of silver, or they change the rules and destroy trust in paper markets. Both outcomes are bullish for physical silver long term. But the path between here and there could be extremely volatile and painful for anyone caught on the wrong side. Plan for the worst, hope for the best, but never assume you know what happens next. If you found this breakdown valuable, subscribe to Capital Collapse and hit the notification bell. Drop a comment with your analysis. Are we heading for a COMEX default, or will they find a way to kick the can down the road? Do your own due diligence. I will never ask for your money. I will never pitch invest with me schemes. I will never run paid signals or funds. This channel exists to provide data, analysis, and perspective. What you do with that information is entirely up to you. Invest with logic, not hype. Capital Collapse, out.